Hi, welcome to the Fed Endeavour. So hi guys. This video is just a bit of an endeavour into the Fed really, and the meeting that we have coming up this evening or this afternoon if you are in America. So I'm going to start off by looking at what's the context we're entering, what are the expectations for the event. So what we have here, these are the Fed's, these are future contracts for interest rates, and these are used by big institutions, hedge funds, large retail traders can get on them as well, basically to hedge exposure to interest rate rises. They work very much the same as any futures contract, it just follows interest rate. And as you can see here, what I would say is though, sorry quickly, is that the lower the price, the higher interest rates expectations are. So the lower the price, the higher the interest rate expectation is, to make that clear. So here, if we start at the 1st of January, this was at the start of the year, this is 2015, expectations weren't that high. I mean, there was a meeting in January, and people did there was a slight expectation that they were going to rise, but the Fed contracts didn't really price that in, so to speak. I mean, we haven't got a relative point to this before, but it's not that low, especially if you look at it now, but we'll come on to that. So if you see here, this is the start of January, and this has been the course of the year. Not much expectations of a rate hike, arguably they're getting slightly more so, if you drew a trend line. I mean, slightly lower, marginal stuff. But then we came to kind of September times, and people started to really think there were going to be some interest rate rise at the September meeting anyway. As you can see here, people started buying these contracts. The contracts started getting cheaper and cheaper, representing a high interest rate expectation. Jumped back up, and then we didn't get the rise, of course, because if you don't remember, we had that commodity sell-off combined with fears of China. They were a bit of exogenous variables, they were running together kind of thing, and then jumped back up. We had poor NFPs as well, and that really, people just stopped thinking they were going to be a rate rise. And then we came to last month, and boom, look at that, straight down. People think they're going to, what you can deduce from this is people think there's going to be a hike. People are hedging themselves. You don't have to just look at the settle rate for this, you can also look at the open interest. So this is how many people are holding the contract on the previous day. Pretty much previous day open interest, and as you can see, a lot of people holding the contract, carrying them through. Once again, September dropped off after September. Failure to rise after commodity story and everything. We've got a little double top on this chart as well, and then just bang, sell off. Quite quick as well. People just cut their exposure, as you can see. Put it back on here, kind of thing. And this was yesterday. This goes up to yesterday, by the way, the charts, and then go from the 1st of January. You can also see it in the volume. Obviously the volume around September was quite large. This is a bit of an anomaly, but if you look at the start, I'm sorry, my little things here, recording thing, but it pretty much does this all the way along. We can look at the 2nd of February. You see the volume is much higher. A lot of people hedging themselves, selling, buying contracts and so on and so forth, trying to get some exposure to the rate rise, or trying to close exposure to the rate rise, kind of thing. So that tells you the context. The context is the market is going to expect something to happen. They don't expect a rise anyway. It's 0.25% is the actual statistic that it's calculated from, and it's about 70%, just above 70% at the moment. I think about 75%. The probability of a hike today. So knowing all that. Where does that leave us with the trading and everything, because it's expected. Let's take a look. We're going to take a look at some charts, and what we're going to do, if I just go back on the settle chart here, we're going to compare the today, what could happen with the expectations from what did happen on September and in January for those rate hikes. Those Fed meetings. I'm going to check. I'm going to see if we can draw any conclusions for what could happen this time. So let's get those charts up. Hi, yeah. So yeah, this is a chart of the S&P 500. Well, that's just not made it very clear. But it was S&P 500. If I put that back up. This chart of the S&P 500 daily. We're back at the start of 2015, a year ago now, almost a year anyway. And the January 28th meeting. This is the first meeting of the month, of the year even, but obviously of the month. And it was a failure to rise. There wasn't great expectations. I think the Fed probability was about 40%. I mean, it's a large minority that think they were going to raise. But as you can see, the failure to raise led to a sell-off. Arguably due to, people pricing the fact that cheap money is going earlier. They realise that, and they start, maybe downsizing leverage. Brokers start closing people's leverage off. Traders start, people who can pay off debt. So arguably, that gets priced in. But then when they fail to raise, it just shows that the economy is not as good as they thought it was, maybe when they started provocating, such as here. So here, this was so the failure to raise in this instance, arguably, was due to the economy, made the economy look worse, because the Fed isn't willing to give its backing. That pretty much sums up. If we take a look at September as well, and September was on the 17th, so let's just find out 17th. Sorry about this. And as you can see, September the 17th is there. Was it there? Look at the dates on each of those dates are a bit weird, but yeah, it's there. 17th. Look at this. We had a rally into him. Obviously, we had this huge sell-off. This is important to note. This was just fear around economy, basically. China story, slow down China. Commodity story as well, linked to that. And then linked back to that. There was a bit of an intertwined kind of circular motion that well, you can see what it did really, quite visibly. But yeah, people were still expecting them to raise. They cut back their expectations because of this sell-off. It's quite easy to understand why. The fear that this is demonstrating, it was just replicated for the American economy. So people cut off their expectations for a Fed rate hike. We did see it rally back off the lows, but then they didn't rise. There was still probability that people believed they were. Investors still counted the probability that they were going to rise. Once again, them not rising, confirmation, economy not as great as they originally thought. Is usually the word they use. And it's sold off. So what we're trying to get at here, what I'm trying to get out here anyway, is that there's a recurring thing where if they don't rise, investors expect them to rise, it sells off. Now, as we saw earlier with the settle rate, expectations haven't been this high for them to raise in a long time. They haven't actually raised in a decade. Last time they raised was 2006. So they were just cut under a decade with if they raised this month. So yeah, man. Likely to see if they don't raise a sell-off. I'll draw this on like this. I think it could make another extension down. We probably would break through this level, I'm thinking, and I'm thinking towards between these two levels. If it's only weak, I think that would be medium to weak, that kind of stuff. If investors really took it as this is the Fed acknowledging that the economy is nowhere near as strong as everyone expected it to, they expected it to. We're talking about levels down here. 1850 kind of thing. I don't know, it's an interesting one. So that's what happens if they could, if they didn't raise. Why wouldn't they raise, I suppose, is the question. There's citations such as recovery is still weak. They cite manufacturing being really poor. That statistics being poor for quite a bit. You still have quite a few unemployed people. But the main problem within that is that they're underemployed. Those in employment are underemployed. That means they don't get paid enough to really meet a decent standard of living. And you've still got huge amounts of people outside of the labour force. I think the labour force is currently about 62 to 63%. So as you can see, there's quite a lot of potential labour there that could come back, that needs to be getting back in the market to really produce stuff, to really get this kick started. So those are two things that are saying the Fed shouldn't raise, because basically you still need the Fed behind you to get this recovery going, keep it moving and everything. And as I say, for those reasons, well, not for those reasons, people who think there shouldn't be a rate hike cite those reasons as not being a rate hike. But as you can see, all those reasons are negative. There's no positivity about them not raising. It's not like saying if they don't raise, that means the economy is great. It means the market's great. Thus, sell off. However, there is a thing that happens on these indices quite predominantly, which is that when you get a kind of release such as they don't raise, you'll see it rise first. It's because cheap money is lasting. You're highly likely, medium to high likelihood of you seeing it rise first and then selling off. It's because cheap money is, people are just quickly buying because they know cheap money is laughing. Well, you are laughing if you've taken advantage of the cheap money, but that's neither here nor there. Could rally up, sell down again. Cheap money, sell off. Bad economy, bang, down. This is also the case in the inverse, if they do rise, and if they rise by the expected 0.25. Let's just get rid of that line. Let's draw a new line in. This one, positive, like this. Nice little rate hike. Go up to 0.25. Let's say we're raising pretty much because the economy is good. They cite the recovery is gaining strength. They've got the economy down to near full employment. And an argument that the Fed won't put it forward probably, but a lot of analysts and general traders do, about the need to put interest rates up, is because the Fed at the moment doesn't have many tools to fight back against a recession. So those are the arguments in favour. So I wasn't meant to draw that line. And if they do so, the expected reaction, I'd like to see an upward move. I mean, arguably it's priced in, so it won't be so bullish. It's a big event though. There's going to be a lot of traders around the world trading this event. It's not like a small event when some people pay attention, some people just know it, and some people trade it. Traders will be there, investors will be there, big hedge funds, banks. These are the people who can really move markets, along with the Fed. So you could see some moves, even if it was an expected result. Once again, expecting a buy. Rally on that, but we could see it fall first. Small move down, maybe not small, quite a proportionate move, but back up anyway. So as you can see, we can get these shapes going, these kind of like moves, making their own kind of like waves, if you like, going like this. Those are one of the two options. However, there is a third option. I haven't really heard this one discussed. But this is kind of what I think is likely to happen. We're going to see a hike, but we're not going to see a hike of 0.25. I'm thinking that we'll probably just see a hike of 0.05. Two reasons for this. Two reasons that combine into one. The two reasons are that you have the people who say that there should be a rise, citing recovery is gaining pace and there's near full employment. And what happens if they don't hike? That's one reason. And there's those that say they don't they shouldn't, citing the recovery is still weak, manufacturing is poor, such as large underemployment, and still large people out of the workforce need to keep money cheap to keep the recovery going. Thus, if you rise by a small raise of 0.05, right in the middle of those two arguments, bang, you don't please everyone, you annoy everyone basically, and by doing that you get it right basically. You can't get one side them viciously attacking, you can't get the other side viciously attacking, and we'll see, it's probably a nice rally. You won't see any of these curvature moves in my opinion. You'll just get a rally up. Cheap money is still lasting, it's cheaper than people expected. The economy is strong, it's acknowledging the economy is strong, keeps rising. So yeah, that would be the straight move, straight up, like this. And that's pretty much what I'm expecting. Those three alternates. Yeah, so that was quite a quick video. I'm just going to end it there. If you have any questions or comments, please ask them. I'll be happy to answer them and everything. And yeah, happy trading, good trading, and good luck.